I'm Keith McCullough, and welcome to The Pitch. You like those new graphics? Simone likes the graphics. He's going to be the leadoff batter here. Big baseball fan he is. But the deal here is we have 6 analysts. They get 10 minutes each, 6 minutes each, and then I get to ask some questions. I have somewhat of an idea. I was going to say I have no idea, but I have somewhat of an idea on what they're going to potentially go after here. But I don't know specifically what ticker they're going to pick. That's what makes it fun for me. Hopefully it's fun for you. And most importantly, hopefully you're learning how to break something down in terms of analytics. You know, again, real analysts, real names, real resumes is what I tweeted. And Rob Simone's coming off a heck of a year. So I'd be quite disappointed if you gave me a long.
We're not giving you a long. So we're definitely not giving you a long. I don't really have many longs to give. So just like I don't have many shits to give about what management teams think about me. So anyway, so we're gonna talk about EPR. Actually, we haven't really talked live with folks outside of our black book. So I titled this one "Experience the Pain." We talked about this as the, they branded themselves as the experiential REIT. That's fine. It's just not fine for them right now. And you're going to find lots of cross currents in this one with many of the themes that Hedgeye talks about broadly. I mean, the first, think about credit. Think about 100% being levered to consumer discretionary, which is really problematic right now. An unfavorable rate of change and just negative catalysts that can kind of, force the stock price to where I think it's going to go, which is lower. Turn to slide 6 on your slides. And for folks who are not familiar with EPR, it's kind of like a forgotten corner of the REIT world. It's very unique. Actually, it shares many kind of like similar qualities with our other favorite short, MPW, in the sense that it is exposed 100% to like very, I guess you could call it like asymmetric or uniform credits, where the underlying real estate doesn't have an alternative higher or best use. So like if you think about a ski resort, it's either a ski resort or it's not, right? Like if you think about a movie theater, it's either a movie theater or it needs to be turned into a parking lot and redeveloped into an apartment building, and that's obviously timely and expensive. So thinking about what we have here, it's a triple net REIT that's 100%, well, it's 100% exposed to consumer discretionary, 41% or over 40% of its EBITDA, that's essentially the real estate equivalent of EBITDA, on a cash basis is exposed to movie theaters. Now, from a credit perspective, that's terrible. So if you think about where this company is right now, about 30% of its EBITDA is either in or effectively in Chapter 11. The in part is Regal. So Cineworld fired Chapter 11 bankruptcy protection in early September last year. And I don't know if any of you guys have seen AMC's balance sheet. Like Freebird and I joke about it all the time, but it looks about as bad as you can get. Even in talking to EPR, the CEO told me that every morning he wakes up and thinks about like how they're going to manage through the ultimate AMC filing. So something to think about on the credit side. And by the way, it's a credit to them that they recognize that, they're willing to talk about it, and they're managing through it. The problem for the stock is it's still a negative. So just thinking about the portfolio composition, again, 40% movie theaters, then there's some, ski resorts, Topgolf, fitness, et cetera. It's 93% fee simple, meaning they own the real estate, and about 7% mortgage exposure. Next slide. A lot of colors here, but it basically shows the underlying tenant exposure. Focus on the middle bars. So look at blue and those 2 greens, right? So if you notice, that's AMC, Regal, and Cinemark. You kind of wind up in the same place as where you started at the end. It's about 30% exposure, right? And so that's what I'm personally worried about. Next slide. Overall, if you kind of look at their tenant roster, their top tenant roster, and look at the credit, I don't see any AAA rated credits here for a triple net REIT. Turn to the next slide. That's very unusual. So some of the higher quality triple nets, and again, this one's different because of its exposure, but you see a large percentage of either or both S&P or Moody's, investment grade rated credit. EPR has nothing of that sort, and that's kind of the wrong place you want to be here, out ahead of what, I'm sure Keith will speak to this, but what we think is going to be a large credit event. Next slide. Essentially what EPR is trying to do right now is outrun, give itself enough time and space to allow the US domestic box office to recover. So in any given year, you were talking about $11–12 billion of US box office. That's what drives a majority of the, the EBITDA that covers EPR's rent. They're still well off that, about $4 billion behind. EPR is trying to manage through that. At the same time, slide 11, if you think about credit spreads, just compare EPR's net effective cap rate to like something like a triple B yield that's reported by the Fed. Credit spreads have not widened. As a matter of fact, they've actually come in, which should scare the shit out of everybody. Next slide, what the bulls will say as well, on an absolute basis, it's trading at a cheap multiple. I say I don't care, because what does that even mean? Right, like you need to have an anchoring point relative to some other, like, credit metric or credit reference point, and when you compare that absolute multiple to a relative credit metric, take the inverse, what you really see is that spreads are flat to down. And what I would contend is when they widen, that should really be scary. Like, people should be looking for a better entry point if you're looking to get long. Skipping ahead, slide 14, simple math exercise. It's a mid $20 stock. Slide after that, and I'll cut it off here. If you think about like what happens when you actually restructure AMC specifically, and then obviously Cinemark, if they do OpCo conversions, that income will be valued at a theater multiple, not a rent multiple. It kind of takes the place of an outright rent cut as an interim step, but either way, it drives the stock price lower. So I think you have bad credit, bad tenant exposure, narrow spreads, and a catalyst to get you to a mid $20 stock price. So that's the idea. And that's all for me.
So that would be cutting it in half from here.
Yep.
And I'll give you all these for all the names, just as the analysts go through it. Risk range on it is 38 to 43. Trend resistance is 45. It's the setup's almost perfect here, Rob. We're back at the top end of the range. It's passively owned. 25% of the stock is owned by BlackRock and Vanguard.
Yeah.
How much of that's a question that's not fundamental. It's more about flow, or what Mike Green will constantly talk about. How much of that is just forever and a day people have flowed into REITs as an asset class, and the BlackRocks and Vanguards are really not distinguishing in terms of analytics at the single stock level like MPW or EPR?
Yeah, a lot of it. I mean, what's interesting about names like this is you see the REIT mafia, the corner of the investment universe that just focuses on REITs and that's all they do.
Yep.
They shy away from names like this, which to me is like oftentimes very telling.
Yep.
And what happens is you get the passive money that kind of flows in because it's in an index. They need to own it, and it just kind of flexes up and down with how the index trades. So like, I don't want to call it dumb money, but you have very like non-analytical money looking at the stock that might be missing a catalyst, like a negative credit event, could really like torpedo it. So,
I mean, Citadel's actually got 1.4%. Now that money can come out in a hurry if there's analytics behind it. Only 6% short interest, which is very low relative to top-end shorts where they ultimately go. What's the pushback you get on it from hedge funds? Don't start, not valuation. I don't want to waste people's time.
No. AMC has more runway before it needs to restructure its balance sheet than I think. And if you think about that, like Q4
like
is usually
a couple more weeks or months.
Maybe, honestly, maybe. So like the thought is they could push it till the summer. Now the Q4 box office, which is the strongest seasonally, was weak, and the 1Q box office, which we're in right now, is always the weakest seasonally. So like I would contend that they're up against it. People are basically you're making a bet that AMC can live longer than like we think it can.
Yeah.
So that's the bet.
I mean, see how ridiculous it can get? I mean, I thought you were going to say AMC is going to last like 3 years from now.
Yeah.
I mean, no, you're like 2 quarters.
And by the way, like all you need is widening perception of risk via the like credit spreads, like we talked. We don't even need a filing. You just need like people to start thinking about it as a material risk, and then suddenly the stock's high 20s, mid 20s. So.
And just a minute on this, because that's pretty much what we have left. When somebody sees an 8% yield, a listed yield on a REIT, and they're just valuation person who does no research, which there are a lot of people out there on Yahoo Finance, different people that chirp at Rob on MPW that were completely categorically wrong. What does that say to you?
It says to me that, well, it says 2 things. A, you have to understand what's supporting that yield, what's the underlying credit, and more often than not, it means that the dividend's at risk, that like the market's effectively pricing in via a lower stock price a dividend cut in the future.
Yep, falling stock price is front-running a dividend cut, just like SL Green did, which was another great short of yours.
Same thing.
Great job on the short side. Thank you for that.
Got it.
Appreciate it. So again, you get to see, and for those of you that are on the call, you get a lot of the not even breadcrumbs here. You get leading indicators, and we'll talk live. It's a morning meeting. I can't help myself, as you can tell. So again, I'll dig in on certain names, and they'll either fit my quantitative framework, i.e., what quad we're in and what the signal is. So if it doesn't fit that, then those aren't the shorts that I like more. It has nothing to do with Tom's hair. Tom, I do like the flow, though. Yeah, that is looking good, man.
Yeah, keeping it long and simple. Actually, it's so I'm gonna, I'm sorry to do this, but like I the more work I lather, rinse, and repeat around HCA, hospital, pent-up demand, et cetera. So I'm gonna just put that back out here. I was here last time with this at 218. It's up around 250. I think it's got a three handle on it sometime soon, like 3 months, 6 months, 9 months, somewhere in that range as we get it closer to that end of 23, 24 run rate. First slide is just sort of the basics of where this sits in that sentiment uh, architecture. So EV to sales up at the upper end, EV to EBITDA. That's sort of EBITDA is the right correlation for the price. Short interest is low, and the sell side likes it well enough. That's a pretty high rating, but that's typical for HCA. On the estimate trend, this has been the real key on the next slide, just around how that EBITDA line has been trending lower and has actually since stabilized. And I think now is going to be at this point where it's inflecting. You can see the beginning part of that inflection in the lower right, that's the slope of the estimate trend for EBITDA. It's breaking back above the zero line, so relative to itself and going forward. And that's historically speaking, if you backtest that number, the slope of the estimate trend, you get a pretty high batting average, particularly in quad four for healthcare stocks. Get positive performance. The next slide is just the EBITDA trend line versus EV. Basically, you've got over a 5-year period about a 9.92 correlation. So that's the number I care about most. That's the highest across all of the trends. In terms of why, a lot of people didn't go to the doctor. They didn't get, that symptom checked out. They didn't end up in the hospital getting, something done to them. Typically, people get in front of the healthcare delivery system and they get healthcare delivered to them. So that's just the way this works. And if you look at the difference between trend pre-COVID and where we ended up, and then sum all those differences, again, like the top end of that aggregate weekly hours of healthcare. General medical and acute care hospitals, I'm calling that pent-up demand. And I've done that kind of measurement a bunch of different ways. And there's a lot of data out there to support that. In the real time, in terms of how do you track this, what are you looking for? This is HHS data on slide 21, just showing non-COVID occupancy. And this is where the margin is. And this is the thing that's going to get released. So every time COVID waves came, non-COVID volume went away. And cycles and cycles and cycles of that, we've had this big deferral pool pick up. One of the items that HCA complained about and has been the big issue through 22 has been labor shortages. So on slide 22, you can see, again, HHS data, the percentage of hospitals reporting critical staffing shortages, is falling. This number's only been reported since COVID. It's breaking to new lows. Part of that on the next slide is really aggregate labor demand for healthcare, which I calculate as the sum of hires plus openings. In rate of change terms on 312 and 1 month basis, it's all slowing and it's all going in the right direction. And what that's been doing, so on the next slide, you can see that's been starting to get reflected in price. So we had RSV and flu came through, sort of re-accelerated all the labor shortages, which had spiked everything back during Omicron, which in this chart, this is a tracker we use on temp staffing. Since that peak around Thanksgiving, things have been trending lower. AMN's a short of ours. I think I've pitched that here before. But what I'm caring about in this instance on slide 25 is really how much premium has gotten baked in through COVID, right? So, COVID really induced a labor shortage as well as premium pay at the same time. And where we are relative to trend, so the two dark smooth lines are essentially healthcare labor, our average hourly earnings for hospitals as well as healthcare broadly, and then the upper line, the big spike is where Omicron peaked everything out. The mean reversion on the right hand side shows you how much further it has to go. HCA specifically, non-COVID occupancy is picking up. A couple other tracker data points here on slide 27. Inpatient surgeries are basically highly inversely correlated to COVID volume. That they look like they're going to have a good Q1. And then the calculated occupancy, I think occupancy is picking up into Q1 as well in the first quarter of 23. We use some data algorithms. So all the data that comes out this week, ADP, JOLTS, BLS, we use a data science methodology. It was very good for Q4. So They actually printed a little bit higher. I think we're going to get, this data update for Q1 as we go through the quarter should be helpful. I'm looking at employee counts using Placer AI data, self-one data of the employees that are in and out of the building seem to be highly correlated here with inpatient admissions. I'm going to continue to monitor that. On the pent-up demand for surgery, I've got the slide on slide 30. Just that blue line going up and to the right is basically the sum of all the deltas, right? Trend versus actual on inpatient surgeries. There's a lot, right? There's a lot waiting here. There's multiple years of upside, I think. And on the wage side, the same thing. So they've been overspending on wages. I think that has a chance to mean revert. There's about 300 basis points on the wage side, and 10 points, maybe double, depending on how quickly they draw it down. HCA is an app. People are downloading the app more. That means they're getting more care either through the outpatient department or the inpatient department. And then finally, what is this all worth? So the way I've thought about this, and again, like hospitals are complicated, healthcare is slow moving, but the simplest way to put this is if I can find pockets of upside for same store adjusted admissions, which is both a revenue function and volume, I can think through, okay, like I can get 1, 2, 3, 4, 5% extra, right? There's extra on top of what's been forecast. And then on the incremental margin, when you talk to hospital operators, it's all about what's the next person in the building, the next case, that next diagnostic. I've already got all my fixed cost infrastructure. I've got my labor in place. Damn it!
You almost got it.
I'm trying to get there. Anyway, 300 plus.
You think that's where we're going, huh? That's good. So setup risk range on this is 246 by 265. So getting closer to the loan, like this is a stock I'd be buying today, for example. Buying on down days is what I like to do. Trend is 232, so well supported, Tom. And they have the catalyst, which is earnings they've already reported. They announced a $3 billion buyback. So the way that it works is now their buyback window will reopen. That's a fairly significant buyback, but only a 1% dividend yield. I guess they lifted the yield too. I don't know what the new dividend yield is implied here.
Yeah, I think at 1% nobody really cares, right?
Right.
Like this is not a yield play. They've tried to transition people to EPS, which I think is, just given the debt load and the fixed cost overhead, it's not where you need to be. Because where the flex in the model is really, okay, I got $39 billion of debt here. So the incremental dollar of EBITDA flows to the equity holder. And it's, obviously in the sensitivity table, I can push, tens of dollars for every marginal basis point of upside to that point. So, could I get the stock to 350 over, a year's time? Sure. Like as long as this pent-up demand story remains intact is sort of my viewpoint on it.
I mean, it has a lot of the attributes that you'd like to see entering a recession, i.e. it's got low beta, it's got large cap, it's got visibility. People going to the hospital is more visible than going to Snapchat. So again, you have a very good, stable portfolio piece. I mean, and I'd encourage a lot of you to think about, if you haven't thought about it that way before, you certainly haven't been taught that way if you're watching CNBC or some bullshit. But again, it's not about stock picks. It's about having pieces in your portfolio that fit the current macro environment. And that's how we do it. And this is a very good piece in that regard. Just one question. Hercules, who's Hercules? They have 25% of the stock? Is that right?
I don't know. Yeah, I'll take a look. Again, it's like so in terms of that, what you're saying on the factor exposure, two things. One is you were commenting on the call earlier today about, you're in the chop bucket, demand can evaporate for staples. With the healthcare bin, we've got exchanges. So people are going to lose their Medicaid, but they're going to move on to the exchanges. People are going to lose their job in their employer-sponsored insurance. They're going to move on to the exchanges in a highly subsidized plan. So the impact in terms of the insensitivity that HCA medical care will have this recession, is so much lower than it's ever been. There's really, it's really, defensive in a way that I don't think healthcare's been ever. So then the mix shift from Medicaid to a commercial plan on the exchange is pretty good margin. The other thing is that when we back tested the factor constellation that HCA has in quad fours all prior, right? High EV, margin, etc., you end up with a very high weekly batting average and a reasonably good weekly average return. So this is an above average, well above average probability of being a successful stock week to week. And that's, again, like one of the reasons we like it is that quad factor score is so high.
I love that. Quad factor score, heard never other than here. So that's good. It's a much better way to talk about stocks because you include the machine, the quantitative factors embedded therein. All right, thanks, Tom. I'm going to, and by the way, back to that portfolio piece before I bring Felix in. It's also in a long short book. I mean, if you're short MPW or shorting it on up days, buy HCA against it. I mean, they have the same factor exposures at the hospital level. I can't quite hedge out the robe. How you doing, man?
Never hedge the robe.
I'm thinking about going naked long China.
I mean, hedging the robe would involve me going naked. You don't want to see that. Nobody wants to see that.
No, for those of you that don't know, he's wearing the robe at the bottom, literally the bottom of China. He was so demoralized. And we were bearish on China for 2 years. So you can imagine how demoralizing that is. He put on this robe. He had this robe on. So now it's forever. That's going to be your look.
It's going to be my lucky charm, and it continues to be my lucky charm. So Keith, today I'm going to pitch a name that we talked about, but it's listed in the pink sheets.
Oh, even tastier. People love that stuff.
And I think that's the first time and hopefully the only time I'm going to be talking about a name that's listed in the pink sheets. But I'm looking for winners, right? And Didi has certainly been a big winner.
All right.
I figure I will go through 5 frequently asked questions on this company. So let's get to the first slide. So Didi
it's kind of crazy, by the way. Pink sheet is generally reserved for like complete minuscule situations. This thing's massive.
It's $20 billion market cap.
Yes.
So it's it's not small.
Yeah. Sorry to interrupt.
To be pitched on the pink sheets, but hopefully it won't stay on the pink sheets, which I will discuss a little bit later. But Didi, for those of you who don't know what this company is, it's considered to be the Uber of China, but I would argue they're very different in many ways, but it's by far the most popular ride-hailing platform in China. Now, Uber, many years ago, had their own China segment, and they wanted to capture the China app opportunity as well. They went into China, failed miserably, and decided to sell themselves to Didi. Now, so just like most of my coverage space last year, Didi's role was volatile and rocky for most of last year, but the stock really started to outperform their peers in a big way just recently. I went long this name in June. So one of the first questions I have for Didi, if we could go to the next slide, is, are they still losing share after what happened with the regulators cracking down on them and also the competitive space getting more heated recently? And my answer to that is no. They were losing share, as you can see on this slide, but the bleeding in their market share ended in July 2022. It's pretty incredible that even without new users able to sign on, Didi was able to sustain their ride-hailing market share since July of last year. The second question I had on the next slide, what's the recovery story for Didi? On the demand side, orders should have double bottom in December 2022 as we exit out of zero COVID policy. People are itching to travel, so that means they're going to use Didi a lot. On the supply side, platforms and online ride-hailing, driver's license are hitting all-time highs. That's showing new interest and also higher compliance. With the resumption of app downloads and new users for Didi's apps, Didi can now focus on re-attracting the drivers they lost during the regulatory crackdown. App downloads are coming back in a fast way for Didi in China. Their daily download rate in January 2023 already surpassed that seen in June 2021, which was right before their app suspension. Third question I had, how can Didi please the regulators? That's a very important question. My general answer to that is compliance. So compliance is where regulation begins. It's also where regulation ends. Regulators want to see higher compliance rate in this auto industry, period. Also, there have been multiple sort of behind or under the table dealings with the drivers in this industry. In the past, Didi's relationships with their drivers have been quite lax, to put it in a nice way. But as you can see on these two charts, it is heading in the right direction for Didi. Next question, can Didi become profitable? Short answer, yes. But it also depends on their international and other operations. So international operations are in their infancy, undervalued, and often misunderstood by investors. Didi already showed in 2021 that it can be profitable in China, particularly with the operational efficiencies they've generated from their core domestic operations. 2022 was a cost-cutting year, according to CEO Chen Wei. So I do think domestic margins stabilized in the second half of 2022 will return to positive territory this year, given the normalization of their apps and a more normal environment in China. Moreover, if you looked at what happened in 2021, which was the last time Didi reported financials, Didi's driver earnings and incentives grew slower than revenue growth. So what does that mean? That means that's a good sign for margins. There was also chatter of Didi pushing more incentives during the initial phase of the app suspensions and surging competition, particularly from T3. But I think that was only a temporary lift in their expense line. So I reiterate my estimate of normalized domestic EBITDA margins of 2 to 4% for Didi. And then finally, the big question for Didi, when will it get off the goddamn pink sheets and go to a major exchange like the Hong Kong Stock Exchange? I've gotten this question almost every week. And I think it depends on the regulators. With the apps back online, the company can now focus on filling out the paperwork to relist in Hong Kong. I generally think other giants like Ant Group, JD Technology, Didi, they're all in the same boat in terms of being in limbo and unable to list. So if one lists, I generally believe the others will shortly follow. So that's the major.
God darn pink sheets.
Yeah, the pink sheets.
Quickly, Didi risk range 406, $4.06. It's up 8% now, by the way, because you just said that.
Oh, good.
You're moving stocks, buddy. 4.98 is the top end of the range. Trend is down at 326. This is what we call major bearish to bullish phase transition or breakout. These are the best stocks, and in particular when you have a big China factor exposure on it. Relatively no short interest. Does Uber own 37% of this? Do I have this right?
Yes, they do.
So what's the deal with that? Is that a risk or a good thing?
Well, they couldn't do their own thing in China, so they decided to partner with Didi instead. So that's how they own Didi shares.
Are people scared that they're going to sell that, or?
I haven't heard that.
No.
Yeah, I mean, I think they're happy that they have some. I mean, they're not happy given the disaster IPO with Didi 2 years ago, but they're happy that they're able to gain exposure to China via their investment in Didi, I think.
And do some people still think that this was like a fraud?
I don't think Didi is a fraud.
Obviously, no, because we're bullish on it.
I hope it's not. I hope it's not a fraud. I mean, I've looked through their financials. Look, I do think there are things in the ride-hailing industry that need to be rectified, and that's what's happening, right? And that's why the compliance rate of drivers and cars are going higher and higher for the safety of the customers and also for the safety of the drivers. So that's heading in the right direction. It's definitely not a fraud. This is the biggest giant, and if you need to hail a cab or a car in China, you go to Didi. So
And
it's not a fraud.
and the numbers that we were looking at this morning in China, we got to move to Jeremy in a second, but the numbers that this morning's Chinese numbers were the biggest rate of change acceleration in essentially the services economy. So this is squarely right up the middle, a way to play today, like today's incremental China's news. Not that this is a day trade, but this stock should be up a lot today, and it should be up a lot more going forward if the Chinese economy continues to reopen post their lunar or their new year. So,
Absolutely.
So thank you, appreciate it. The robe, McLean, you're not as sexy. You don't have the same outfit.
The robe on, just got the Hedgeye pullover.
But you work on one of our sexier teams, so you and McGough and Ariana and the crew, you guys just keep coming up with new stuff. So
Trying to keep the flow going here, but this is a ticker you've heard before for sure. One that's in investing ideas right now.
Ooh.
So Revolve, RVLV.
Oh, yes.
Best idea short for us, and one I think is one of the best names to be short in consumer right now. And we'll dive into why here. First, quickly, the slide here.
For people that want to
43.
look sexy, that's where you shop, right?
Exactly, yeah. The core customer, as you'll see here on slide 43, is a early 30s to late teens, sort of millennial type woman. And it's an online fashion retailer, so influencer-led model. They use influencers on Instagram, et cetera, to place product, find what's the peak of fashion right now. They do small buys, try to sell out that thing at full price, and then move on to the next item. They sell, for example, dresses anywhere between $20 and $5,000. The core is kind of in a $75 to $250 range. They have a sub-brand called Forward that does a little bit higher price range. But online fashion retailer, we obviously are very bearish on apparel, and specifically here we'll dive into why for Revolve. Slide 44. So revenue trends, right? Much like other apparel retailers, they rode the boom here in 2021 of the reopening, apparel demand, online demand, and just saw huge growth rates. Right, you're up at 60, 70%. You've got a very difficult comparison here in 4Q, another tough one in 1Q, and you've seen what the trends have been. We're down, looking at something around 0, low single-digit growth in the fourth quarter, likely to go negative in the first half of 23. So, growth story that's not really a growth story anymore. And then inventory has become a problem. So slide 45, this is looking at the sales to inventory spread. So that's, so sales are trending towards 0 growth. Inventory is up, in the 50s. And this is a model, right? So contrary to the business model, if you recall what I said earlier, this is supposed to be high full price sell-through. It's supposed to be limited buys. It's not supposed to have inventory problems. And actually, for the second time in its history, it has an inventory problem again here. It happened back in late 2019. So if you go look at the stock in late 2019, the business model was kind of falling apart before we got to COVID. And COVID arguably saved it, which we'll look at here in a second. Slide 46, with that inventory problem, we're seeing promotions as high as we ever have for the company. So they're running, sort of flash sales. They're running, clearance sales. They're running extra off clearance sales. So there's clearly a problem here in terms of them trying to clear out the product that's sitting on their balance sheet. And we moved to slide 47. So this is a really important one. So they're promoting, trying to clear that balance sheet, yet we don't think it's really working, at least not in the live data we're seeing. So this is looking over, since basically the start of the pandemic, what has been the clothing items listed on the site, so like total SKUs, sale items, so items that are on sale, SKUs that are on sale, and final sale items, so things they're trying to clear out, like clearance items. So you see, back right before the pandemic started, they actually were elevated in terms of all these things, over assorted, high sale items. You got into 2020, right? Nobody cared about what your margins looked like in the spring of 2020 because it was the pandemic. You could clear out product. You had online demand. They were able to reset their inventory position. And then over the last 4 or 5 quarters, you're really seeing this step up in the number of SKUs on the site, the number of sale items, and the number of final sale items. So they're all at or approaching their all-time highs. At the same time, we're seeing revenue growth trending to 0 or negative in the coming quarters. So that's they're again facing this big problem that hurt them in late 2019. That was a negative stock event for the company in late 2019. Is trading, I think the multiple got roughly cut in half. So as this becomes very evident to the investment community, we think we're going to see a very similar thing here. Slide 48. Something to be conscious of with this company is the return rate. So returns are upwards of 50%. and trending higher. So this is important for a couple reasons. One, it's just generally not good for your P&L when you're getting high return levels. But two, right, we're coming off this base where supply was tight, demand was high, so people weren't returning stuff as much because there wasn't many alternatives. And now you have the opposite, right? If you're not satisfied, you can go find another item at somewhere nearby for 30% off another website that's being discounted. So excess inventory means return rates likely to keep marching up. And the important thing is credit card data, which we've heard looks relatively good right now, does not factor in return rates, and of course does not factor in what your gross margins look like in terms of your promotional levels. So revenue might be looking fine, but slowing, as we just looked at, and your profits are likely to look a lot worse, and your actual sort of recognized revenue when you factor in returns could look weak as well. So a big risk there in terms of how that plays out in the stock and the P&L in the coming quarters. Lastly, priced like a growth stock, right? This thing is trading at 32 times earnings, whereas we're saying if it's so over assorted, it's really an online department store, right? It's nothing that special from any sort of online retailer or apparel retailer in general, except maybe its channel's growing better than the brick and mortar channel right now. So it's trading at 32 times. What do we think it should trade at? If we go to the last slide, 50. This is our earnings and valuation summary. We're looking at sort of 35% downside in the earnings expectations in the next couple of years. We think this should maybe trade at we'll give a mid-high teens multiple. That's maybe even somewhat conservative, but because it is an online channel that's growing, we'll give it a little bit of a boost relative to brick and mortar retail. That gets us the stock kind of in the low double digits versus last night it was about $27.50, and right now I think it's a few points higher than that, around $28 or so. So short revolve.
That's a great summary. This is also a very good example of a small to mid cap, or it's really a small cap retailer with high short interest getting squeezed.
Yep.
So you get a whole new setup born out of, this wasn't too long ago. I'm old enough to remember the end of last year when this thing was at 20, right? So you can go from top end of the range, first of all, is 31. Low end of the range is 22. Trend is 35. It's actually very typical, this kind of a setup where a stock crashes and blows up in a bear market and you get these vicious bear market rallies. It's just so interesting that this one, at this point, don't forget, this you wouldn't forget, it came down from 90
Yep.
to 20. That's called a terrible situation. But that's how you get to 25% short interest. So I'm assuming that, so again, trend resistance is 35. So you ostensibly, or technically, mathematically, you could be squeezed all the way up to there and it would still be a great short. Because on my definition, that's still bearish trend.
Yep.
But from here, let's say it goes from 31 to 22, you got 10% upside, 35% downside. And we've seen this happen in a lot of your stocks, actually, when they hit D-Day. Marine Max being the most recent, where all of a sudden it's just a big flush. My main question is, how many of our clients are absolutely petrified of their own shadow, given how obvious this one is, at least to me, to short this?
Yeah, a lot of them are. We're talking to a market neutral fund just a couple days ago, and we brought up this name. They're like, yeah, I'm not involved, but the multiple just makes no sense to me given what the business is and what the direction is. So they're looking at get the pitch, and they're just afraid to short it because of that short squeeze dynamic. So we know some that are, but there's definitely a little bit of angst around that, and they kind of want to see it start to crack first, and then they kind of pile in is the narrative that we're seeing, at least for our customer base.
It's interesting. It's just not how to short sell. We got to teach our own clients, train our own dragons. Just wait for the bloody thing to get to the top end of the range and then start clipping into it. If you wait for day one of the decline, you're going to miss it. That's just not how I do it. Kane Anderson, who's Kane Anderson? They own 7% of the stock.
Yeah, so they're a large asset manager. They're I think they're based in LA, so maybe that's why they're interested in this one. This is an LA-based company, but they bought a bunch of the stock kind of on the sell-offs, earlier last year. So when it went from 90 down to 30 or something, it looks like they were loading up, and they weren't shareholders before that. So
the buddies of the CEO? He sold into them.
I don't know if they have a relationship.
Yeah. Stock into them.
Yeah, the execs don't own that much money. It's an interesting management team too. It's a very fashion kind of designer management team. The guys, I've never met them in person. We've spoken to people that have, but they're laid back. Right now they've got this inventory problem. They're talking about building DC space and using that to pack away inventory with excess goods. Like that doesn't work in fashion. That's a big no-no. Like you talk to any management team that has like long-term experience and cycle experience in apparel, like you don't do that, right? So.
But it's cool, bro.
Yeah, we'll sell it. We'll sell it next year. Right?
Thank you. Very good. Very good rundown. And again, I think that the risk management setup on these things, in particular when it comes to McGough's names, is critical. You either understand that there's a recession. Again, we think GDP is way worse Q1 and Q2 than today. The IMF said that everything's bottomed. I mean, there's a wonderful short selling opportunity here. We're trying to educate you in terms of how to do it professionally. Again, it's okay to be a happy short seller. You make money, okay, as long as you understand that timing matters. I don't think, Daniel, again, I shouldn't think. I should just do. But I don't think you're going to pitch a short, are you?
No, in quad 4, I got to bring you along, right?
You're so popular right now.
So I'm bringing you the sauce, if you know what sauce I'm talking about, and that's Lancaster Colony.
Oh, yes.
Ticker LANC. Lancaster Colony has the special sauce, right? So point number 1 I'm going to make
I thought you were talking about my underwears. I wear Sauce Hockey underwear.
Oh, that's right.
I'm sure everybody really wanted to know about that. Go ahead.
Margins have inflected, so expansion is ahead for margins. In the last quarter, September quarter, gross margins contracted only 30 basis points year over year. That's improving sequentially from 330 basis points. That was their fiscal Q1. It was a favorable sort of setup for them, but for the remainder of the year, they're going to have tailwinds, including new capacity, supply chain initiatives, falling commodity costs, and additional price increases. So I have margins expansion ahead. Point number 2. I think this is the best public investment vehicle to invest in the growth of Chick-fil-A. I mean, the only other way I think you can invest in Chick-fil-A is to go run one, because you can't be a franchisee of more than one, right? So this is it. I think this is the best way, and you don't actually have to be manning that drive-through.
Well,
So-
they have better margins than Chick-fil-A, I assume.
Than McDonald's?
Lancaster.
Oh, Lancaster? Well,
You just own the sauce. You don't have to own the damn whole place. Yeah.
I don't actually know what Chick-fil-A's margins are, but I think they're probably pretty good. So Chick-fil-A represented nearly a quarter of Lancaster Colony's sales in 2022. Chick-fil-A has decades of new store openings ahead of it, providing Lancaster Colony, as a manufacturer of its sauces, visibility in its future revenue growth. The combined growth of Chick-fil-A's restaurants, where they're selling the sauces to, and as well as the grocery stores where they're selling Chick-fil-A sauces in grocery stores, that provides over half of Lancaster Colony's expected revenue growth for the next couple of years, and it has contributed to that in the past couple of years. And then point number 3, we're modeling positive EPS revisions. So I see a cycle of positive EPS revisions going ahead. So the last quarter they reported $1.36. Consensus expectations were $1.11. I think you get an idea of what I expect going forward. Consensus expectations for this year are for gross margins to only expand a modest 120 basis points. Not only do I model higher gross margins this year, but over a 2-year period, I think gross margins is going to expand over 400 basis points compared to where it was, and returning to above pre-pandemic levels. And that's partly due to the new capacity expansion that I'll get into, and that should lead to higher than historical levels. Our estimates are higher than consensus on a trade, trend, and tail duration, and a debt-free balance sheet provides options that really aren't reflected in the current estimates. So this is a best idea long for us in quad 4. On the next slide, slide 54. So this is just to give you an idea of what Lancaster Colony does. This is their sales mix. It's 55% retail. That's at the grocery store, 45% food service. So in the retail, it sells a lot of frozen bread, right? It's also stale bread known as croutons that you put on your salads, and a lot of salad dressings. That's sort of the old business. And the food service side, they have more than half of the big QSR chains represented as customers. So Lancaster Colony is who the restaurant chains go to develop a new sauce, right? Coca-Cola does that in beverages. Lancaster Colony does it in sauces. And this is becoming more and more popular as restaurant chains are trying to develop more sauces. The younger generation is much more into these new flavors, right? So that's where Lancaster Colony comes in.
Older generation, too.
We follow the younger generation on that, right? Good reason. We're calling ourselves the older generation now, Keith. So the portfolio here, to give you a little idea of what the sales are, is on slide 55. And the next slide, I wanted to talk on Chick-fil-A because this is one of the major reasons here. So Chick-fil-A is one of the fastest growing large restaurant chains in the United States. It has grown double digits annually since 2010, and it is the third largest restaurant chain in the U.S. So it has grown from 14% of sales in 2019 for Lancaster to 24% last year. Last year, it grew over 30% despite being capacity constrained. And when I talk about capacity constraints, this is what they did. They opened up a new expansion at their plant at the end of the last year, and that's going to just enable the innovation pipeline going forward. So when you're limited by supply, you really have to be really choosy on what you're going to launch at retail. And on slide 58, you can see what I'm talking about as far as an innovation pipeline. You can see that it's also flavors, but it's also different size SKUs. You can go, and then it opens up different retail chains, and then they have different. They're going to launch, Chick-fil-A dressings, and then you see examples of Arby's, Buffalo Wild Wings. We're just going to start to see this innovation pipeline sort of reopen with this new capacity expansion. On the next slide, it gives you another example of some of the other products, more of their legacy businesses in croutons and salad dressings. And then, it does have a history of acquisitions. It's not overly acquisitive. They've done a couple, maybe one every couple years, but it's contributed to growth, and they layer it in, and they can add the distribution. It's sort of a virtuous cycle, right, where they have that distribution, and they can add, expand what they're acquiring into where they're already currently selling. And with a debt-free balance sheet, I think we're going to see something in the not too distant future of what will propel them going forward. And then finally, on slide 61, Lancaster Colony has a strong history of being a quad 4 outperformer. And I think some people talk about the valuation, but I think if you look at its range historically, it's in the middle of its range. Remember that with a debt-free balance sheet, you could have the same EV/EBITDA, but you can move it from the balance sheet to the equity and get a higher stock price if they choose to do that. I think they're going to do something more on the value creation side than just simply buying back stock. They are a dividend payer. They have a long history of increasing the dividend. So I'm not expecting something significant on the share repurchase side, but I do think a good acquisition would be a catalyst that we're not really sort of projecting currently.
Good. You timed that literally right down to the 2. So you see that? Do you see how many seconds?
I didn't want to hear the buzzer.
You're just. It's in my ear. It's brutal. Just hurting. I'm in the hurt locker. Okay? Obviously, I can handle that. Setup on this is good. It's been part of the basket that the winner's basket they've been selling. The machine being the loser's basket's been squeezed. So you get Revolve up, Lancaster down,
Yes.
which is a little squirrely until we get to D-Day, which is of course earnings season for the next 3 quarters, which should be quite interesting. 187 to 197 is the risk range. And trend support is all the way down at 173. So it had such a big move.
Yeah.
It's typical to have mind your gap, like a pretty good step down. And what I like about those is when the 50-day moving monkey breaks. I don't know if this one has because that's not my primary screen. But then you get the momentum people selling it, and the fundamental people can come in and buy it. So the setup is quite interesting on this one. The short interest is fine, $5 billion cap, but it's got the 2% dividend. Mm-hmm. Question, who is John Gerlach? Or Gerlach. The John Gerlach Trust owns 16.5% of this.
Yeah, I think that's from the founding family.
Okay, and then the junior John, John B, has like almost 6% of the stock.
Yep.
Then Robert Fox has 4% of the stock. I mean,
yeah.
These are tough to break. You know, when you have the insiders own. I mean, just right there, you have, a quarter of the stock is held by these 3 places, which are all the same place. And
then you add in, I think, just the index funds. I think they're a large ownership of it as well. So I think what you're missing, and you do have some hedge funds in there, but I think what it's missing is just the other long onlys that would typically be there that are more active, right, rather than the index long onlys. And I think that's where it's missing. And I was just marketing in Canada recently, and I was telling this story. No one's heard of it, and I don't blame them because they don't have many Chick-fil-A's. I think they only have 4. But that's part of why they probably haven't even heard of it. And I get that a lot institutionally. A lot of people just haven't heard of it, even though it's a $5 billion company.
That's the thing about life, right? Just because you don't know about it doesn't mean it doesn't exist.
Right.
I mean, sorry to my friends in Canada. Sorry, hey, bud, you don't know what the Chick-fil-A is, but it would do well there. It has done well wherever they have it. But I mean, this is not a qualitative investment. These are great dynamics, great P&L dynamics being, and certainly different. And this is actually the point about coming into quad 4, out of quad 4, and into the next bull market. The next bull market could be a portfolio of stuff like this, gold miners, healthcare stocks. It's not your former bull market. And until everybody's talking to me about how they love their tasty LANC, it's going to be what it's going to be. Low end of the range is approaching, by the way, and you know what I do. You know what I do when I see that in Lance. So again, thank you. Appreciate it. He is Daniel Biolsi. Now, my second Zoom conversation, where sometimes his connection works. Look at this, the evolution that is Jay Van Sciver. You're not like sitting in some corner of your dwelling. You look like you fancied it up.
Yeah, I borrowed Ami's background, but we do have a short for you today.
Oh, nice. Nice.
A proper Bob Rich cartoon, if you look at the title slide, Fed Farms, right? And I was going to do something like, a profitless growth company or whatever, but a lot of them are down. And instead, I'm going to go with a cyclical, right? Because we're entering proper quad 4, right? Recessionary macro conditions. A lot of these cyclicals are at all-time highs. And there are some ones that are just fantastically interesting, a little niche, a little artisanal that maybe people don't know about that I thought would be fun to hit on. So looking at the overview slide here, we have a farm asset bubble, right? And I don't think a lot of people realize that farmland prices are in a bubble. We've had a long period of falling interest rates and borrowing rates, and that is something that higher rates right now can start to prick, and it wouldn't take all that much.
Just what I needed, another bloody bubble in the whole mother of all bubbles, a farm bubble.
This one's very good. This is something I think people haven't focused on, and when they see it, they're like, oh my God, right? And you can see farmers tapping that asset value to borrow incremental, amounts of money every year, and that supplements spending that allows them to buy tractors and things like that. And keep in mind that farming is sub-GDP growth. So this is not a fleet that grows. It's actually a fleet that over time, because the tractors get bigger, will tend to shrink. Farm equipment sales are fueled by credit, and we have higher rates for borrowing, right? So as we enter quad 4, and you probably see some pressure on off-farm income, I think you start to see, farm equipment sales come down from very high levels, right? We're kind of peaky right now, peak margins, peak sales. And I think, cyclical shorts are where we want to be. We have Deere trading at a high multiple of peak numbers. You can say what you want about valuation, but it does tell you something about what's kind of baked into expectations, right? So people are paying a high multiple for a sub-GDP growth industry, that basically has sales resting on top of an asset bubble. I think it's a pretty interesting quad 4 bear case, right? And it's not hard to imagine how a narrative gets going with ethanol and EVs and all that crap too, where you start to see a little bit of less CapEx into the farm space. So what does Deere do? If you didn't know, Deere sells farm equipment. They also sell a little bit of construction and forestry, and they have a finance subsidiary that is also pretty profitable. If you also didn't know, 66, farming, that's what Deere does there. That farming is the third oldest profession after mining and is sub-GDP, right? It's definitely not a growth market. And it has had a good run here on 67. If you look, you want to buy cyclicals in say in this chart, like 2016 or 2001, right? You want to buy them when they're not making a lot of money, margins are down, and backlogs are drained, right? You want to play opposite day in cyclicals. And what you can see is actually Deere is up on a rope. And this is one of the big things I think that people are missing for both Deere and CAT. You saw CAT out today. They're seeing a lot of cost pressure. That's on our short bench, and it's down today. We just added that fourth quarter with the first quarter 23 themes. But look at these borrowing rates, right? These are up hundreds of basis points to buy a tractor right now. That's going to limit availability. That's going to increase the cost of these tractors. And a lot of them are financed, right? So you were borrowing 2.5%. Now you're going to be borrowing more like 7.5%. And this is the bubble here, 69. This is the chart that I don't think people realize is that this is, there are different grades of farmland and whatever, but this is Iowa farmland.
Oh
up
my
about
God.
4x in real terms, right? Now, initially, this was going to roll over, and then you hit the COVID stimulus. You got the negative real rates. This is what's, this is also, you can see it on the next slide too, in terms of borrowing rates here. You can see
shit.
lower rates, it's not like rocket science. Lower rates allowed farmland prices to go up, right? But this is the important one here on 71, is it's allowed farmers to borrow ever more against that real estate, right? So every year they can get a little more money to spend to buy tractors and irrigation equipment and whatever they want by borrowing against that farmland. Now that doesn't matter because farmland went up 4x, right? Like, great, it looks like it makes sense. But if that farmland starts to go down in value, you're not going to have the same kind of increase. And anyone who remembers farming in the 80s, I'm not forecasting a repeat of the 80s, but you can certainly spin that narrative, right? Like that isn't that hard if you have the kind of increase in borrowing rates and the kind of bubble you have in that asset and the kind of leverage. So one of the things that you've had, it correlates really well with the farmland value, is actually the age of farm equipment. Farmers have money, they buy equipment. On 72, you can see the fleet is actually pretty young. It was younger a couple of years ago, right, at the peak of the commodity boom, 2012, 2013. But realistically, it is not at all. You don't have this pent-up demand, right, that a lot of bulls would like to see. So realistically, you have this interest rate and growth sensitivity in ag equipment that is not being recognized by the street. The street thinks that Deere's going to earn more next year, like $28, and if you just kind of put in a regression to those rates, you get more like $10, right? So a huge miss in EPS potentially coming over the next, may not be immediate, it might take a couple of quarters to play through, but it could easily be the next 6 quarters. Significant revisions down in EPS estimates from peak numbers, pretty typical cyclical, and it wouldn't take that much for markets to panic, right? As the scope of that downside becomes clear, and you start to see people talk about like, oh my God, ethanol isn't going to grow because of this electric vehicle thing, right? And realistically, it's just not a growth market. And you have a young fleet trading at 18 times earnings, right? It should be at 8 times peak earnings. So it's not that hard to get 50% relative downside as investors get reacquainted with just how cyclical cyclicals can be, right? Volumes go down, prices go down, and unit costs go up. Like that whole thing becomes very dramatic, and everyone gets slaughtered in that kind of a situation. Or it can make a lot of money, whichever side.
It is rare that I am caught off guard by anyone on my team like this. In particular, in my domain of said expertise, which is identifying bubbles. This thing, I mean, just take out any of your fancy charting tools that you all have out there and pull back hit the button that says all-time chart. Oh my God. I mean, $100 stock, going into 08. 165 was the all-time high going into the pandemic, which is sufficiently higher than the prior cycle high. This thing is still at $419. And if you just look at the chart and you step back, like this, I like to do this. It's really deep technical analysis. It's like far greater than Fibonacci. Just take a step back from the computer, especially if you can't see like me, and then put the Iowa farm price chart against it, and you'd be like, it's a similar set. It's like the same thing. It's unbelievable.
But you need the higher rates to get the farmland bubble and whatnot to, and the cheap financing rates for the equipment. They're all, it's a similar set on the downside. As you roll down the hill, right? And it's a very big hill. Now, Deere isn't a zero or a fraud or anything like that. It's just a deep cyclical and a no growth end market.
We've done really well with our bubble cap stocks, bubble cap shorts, Microsoft, just go down the line, Google, Microsoft, Meta before they changed the name. That was a big sign of the bubble there too. But this thing has $125 billion in market cap. Pre-pandemic, that was a lot of market cap. That would be called a bubble cap. So it's got that. It's got another thing about bubbles is that nobody wants to short them anymore. It has less than 1% short interest. Okay? That's a bubble. Bill and I hate to say it, Bill, but you got enough issues right now. Bill and Melinda Gates Foundation own 1.5% of the stock passively, but Cascade, which is his active fund, has like 5% of the stock. So 6.5% to the Gates. Which is really interesting because again, that's not exactly somebody at the wheel specifically. They're not criticizing the people at Cascade. I'm talking about Bill. This is really interesting. Risk range is 403 to 426. It's signaling lower highs for the first time. That's a very good thing when you're looking at bubbles. You want to see lower highs because that's the beginning of the popping. The real popping is breaking the trend. Trend, get this. Stocks at 419, trends 414. 414 at 314 is what a bubble looks like, okay? And I don't mean like tomorrow like some idiot. I mean over the course of the full investing cycle, cost of capital is high, real estate bubble imploding. This is a beauty, man. I love it.
Yeah. February earnings release, it ruins every holiday. It'll ruin President's Day for me.
Oh, by the way, on that, are we through the open the envelope event? Like, have they already reported or not?
So their fiscal year end, so it's February, it's the Friday before President's Day weekend. So if you do pick up deer, just know it's going to ruin your August vacation. It's going to ruin Thanksgiving. It's going to ruin President's Day because they report the day before all of those things.
Good. Something to look forward to. And please wait for days that it's up on green. That's what we want to do. With the shorts, we didn't just have shorts. It looks like we have 2 longs and 4 shorts. Good balance. It's a net short day here. But again, take your time. Take your time. The most important thing that you should have as a buyer of stocks, don't forget Wall Street is in the business of selling you stock. So you should be very careful about that. Risk management matters. So again, understand what economic quadrant you're in, understand what signals you're in. This is where we start, and then we get into the stock picking. Many people on Wall Street start the other way around. They start with their valuation, their ideas. Been there, done that. I'm not making fun of it I'm not making fun of it because these are bad people. I mean, that's what I used to do. I'm making fun of myself, okay? So I found a different way to say the same thing. And again, short selling in particular takes a lot of reps. So understand short and hold's not a strategy. Actively managing these things within the risk range is exactly what I was trying to outline. You have more, you should have more conviction when a short is already signaling bearish trend rather than it not signaling bearish trend. Conversely, you should have more conviction or a larger position in names that are bullish trend. That are again supported with the trend, like Lancaster, well below the low end of the range, which is another very bullish thing. As you approach the low end of the range, that means something might be changing. Lots to think about. Lots to think about. Thanks for thinking alongside me, and thanks to my teammates. They're the best. Thanks for joining the pitch.